Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And I think for this week we need to focus on South Africa's inflation data for the month of May. Came out last week. Inflation moved up to 4.5%, but I think the story is really the fact that core inflation remains reasonably well behaved, and there doesn't seem to be a huge build-up of underlying inflationary pressure. So we'll chat about that a bit. And then the second topic is obviously the decision by the US Federal Reserve last week. I don't think the decision was any surprise. Rates kept on hold. The main focus is the fact that they've got a new chairman. Kevin Warsh is now the chairman of the Federal Reserve, and he announced a number of pending changes to the way in which the US Federal Reserve will conduct monetary policy. And so I think it's useful to discuss what those changes look like and what that may mean for monetary policy going forward. So from our perspective, two important topics. And I think for the coming week, there obviously will be a little bit more focus on what's happening with the Iran conflict. Have we got an actual deal being announced? Is the Strait able to be opened, and are we seeing an increase in shipping activity? We'll chat about that next week, and obviously what that means for the oil price, because right now it would be incredibly helpful if the oil price were to come down further and therefore start to relieve some of the inflationary pressure that has built up over the last couple of months. So let's start by chatting about South Africa's inflation data for the month of May. As I mentioned in the intro, it came out last week. And during the month, the CPI went up by 0.7%. That's high by any standard, but it was a little bit below expectations. The market was anticipating an increase of 0.8%, so a little bit of surprise to the downside. And in terms of the annual rate of inflation, it pushed that up from 4% to 4.5%, which is obviously significantly higher than what the new inflation target is, which is 3% with a 1% leeway either side. So this is certainly elevated inflation in a South African context, and unfortunately inflation is expected to move higher next month because we're not quite done with the fuel price increases, and we're clearly hoping that the oil price can move lower and therefore start to mitigate some of this pressure. But in the very short term, South Africa's inflation rate is going to remain very elevated. I think, though, the main story with the inflation data wasn't the fact that the headline number moved up to 4.5. It was that when you look at the sub-detail, there's not a lot of evidence of secondary inflationary effects. The reason I say that is if we look at food inflation during the month, there was no change. Month on month, that number was 0. And year on year, food inflation in South Africa sits at 1.6%. Now, that would suggest that there isn't a huge amount of upward pressure on food prices. And clearly, there are some concerns in the category because we've been worried about fertilizer cost, we've been worried about foot and mouth disease, we've been worried about the El Nino effect, and obviously just the cost of diesel, but it hasn't yet translated into a significant build-up of pressure within the food category. In fact, there were some elements where food prices actually declined, particularly processed food that actually fell in the month. Meat prices fell in the month. The cost of fruits and nuts fell in the month. So to me, when I look at the sub-detail, it would suggest a fairly muted inflation dynamic for food prices, and that feeds back to agricultural prices as well as manufactured food inflation. So for the moment, food inflation seems reasonably under control. It doesn't mean that there aren't any risks. There's significant risks to the upside, but we seem to be able to resist those risks for the moment. And then if I look at other categories that could well start to reflect second round effects, we're just not seeing that pressure build up. If I look at particularly clothing and shoes, those numbers sit at just above 1% inflation year on year. If I look at furniture inflation, that's minus 5.3% year on year. If I look at household appliances, minus 2.7%. So that suggests fairly modest numbers. It doesn't mean there aren't categories that are fairly elevated, and because of the increase in foreign tourism, we have seen some of the tourist-related numbers move up quite a bit, particularly accommodation services or the cost of hotels. We've seen some inflation in those areas, and then we've obviously got fairly high inflation in electricity, medical aid cost, etc. But in terms of the fuel price and secondary effects, I'm not really seeing a whole lot in the data. What does that mean in terms of interest rates? Well, it should be pleasing for the Reserve Bank that this isn't materializing as yet. Clearly, if we had seen significant build-up of broad-based inflationary pressure, the Reserve Bank would be compelled to hike rates further. I think under these circumstances, time is on their side. They can adopt more of a wait-and-see approach. So it doesn't mean that we won't see a further increase in rates, but I don't think they necessarily will feel that they've got to rush interest rates up aggressively. The interpretation is perhaps they could take a little bit longer and evaluate the data. Obviously, with headline inflation at 4.5%, there is a risk that starts to feed into higher salary increases and just generally a broadening out of inflationary pressure. So that risk is very evident. And what that highlights is the sooner the oil price comes down, the sooner the Strait of Hormuz is opened, then we'll get past that and we could start to see a benefit of a lower oil price in terms of bringing down the annual rate of inflation. So we're at a tricky phase in this inflation cycle. I think we've coped with the pressure reasonably well, but clearly it would be hugely beneficial both from an economic perspective and from an interest rate perspective. If the strait could be opened and the oil price were to move lower, then I think we could end up getting away with only one rate hike as a consequence of the move up in the oil price. The risk is still very much to the upside, but I think it's about the timing and at what point do we feel that we passed the Iran crisis and therefore less anxiety about what oil prices are likely to do. The second topic is the decision by the US Federal Reserve to keep rates on hold last week. So the top end of the US interest rate sits at 3.75%. And it doesn't feel to me like that's going to move lower anytime soon. In fact, the risk is very much to the upside. But more important than that, because now Kevin Warsh is the chair of the Federal Reserve, he did the press conference and he announced some very important changes to the way in which U.S. monetary policy is going to be conducted. I'm not going to go through all of the changes. They're quite comprehensive. He's put together 5 task teams. Those teams will undertake various bits of work and try and get some of that work completed by the end of the year, and therefore we're likely to see many of these changes being announced over the coming months. But to give some idea of what he's likely to do, I think he's going to scale back forward guidance. In other words, eliminate any sort of interpretation from the Fed itself as to what it thinks interest rates are likely to do over the coming months, coming years. He's not a fan of forward guidance, so I think we're going to see that disappear. It already was not included in the latest FOMC statement. I think we're also going to get rid of a lot of the press conferences. At the moment, there has been a press conference after every single Fed meeting. I think they're going to scrap that and only have press conferences when they feel they've got some significant to announce. And then I think they'll do away with the most of the summary of economic projections, particularly the dot plot. Warsh is not a fan of that. So I think there are going to be significant changes to the communication that the Fed puts out. And most of those changes means that the US Federal Reserve is not going to provide a whole lot of forward guidance, not going to provide a huge amount of insight into their future interest rate decision-making process. And I think what they're going to do is hope that the market reacts to the economic data more than to forward guidance. At the moment, what's happening is markets are listening to the Fed, listening to their forward guidance, and then reacting to that forward guidance. And I think the new chair of the Fed would want to see the market react directly to the economic data and not necessarily to what the forward guidance is from the Federal Reserve. So I think that function, or that reaction function, is going to change quite substantially. They're also going to look at changing the role of their balance sheet. We know in the past the Fed has used quantitative easing and quantitative tightening quite extensively. It looks like they're going to want to scale that back significantly and try and reduce the size of the balance sheet quite meaningfully. That's, I think, a little bit easier said than done, because obviously if you were to make radical changes to the balance sheet, you would disrupt the financial market. So I think it's something they can implement over a period of time. And the Fed also wants to change their reliance on existing data sources. They have expressed a concern that some of the data gets heavily revised. Look, the US has some of the best economic data in the world, but it is subject to revision, understandably so. And so the Fed is saying, are there other data sources out there that are perhaps not as subject to revision that we can rely on? And so they've got a task force to explore what data they use and are there any alternatives. The fourth topic is to have a look at productivity and the role of AI. The general thinking is that as you introduce artificial intelligence, you'll improve productivity, and that improvement in productivity may well help to control inflation. And if it does, it becomes a huge windfall for monetary policy, because then the gains in productivity do a lot of the heavy lifting in keeping inflation under control. So there's a separate task team to look at that. And then finally, there's a task team to look at the inflation framework. In other words, what drives inflation, what matters when it comes to the inflation outlook. They're not going to look at changing the inflation target. At the moment, the target is 2%, and Kevin Warsh said that that's not up for discussion. But in terms of the parameters that they use to understand the inflation dynamic, I think that will go through a whole review. So that's quite a comprehensive set of task forces. They'll, as I say, try and report back by the end of the year, and then I think you'll see a range of announcements made, and those announcements, I think, are going to be very meaningful in how they shape monetary policy going forward. The net result of this is Kevin Warsh seems to be very focused on achieving the 2% target, less focused and concerned about the labor market. Obviously, that may change in time, but for the moment, the focus is very much on the 2% target. The US Federal Reserve has not really achieved their target during the last 5 years, and I think Kevin Warsh is going to be determined to try and get the target achieved. And what that means in terms of interest rates, well, the interpretation would be that you're going to have to maintain high real interest rates for a longer time period, which is clearly not going to please the Trump administration, because their criticism of Jerome Powell was that he wasn't cutting interest rates aggressively enough. I think if I look at what Warsh was saying in the press conference, it doesn't feel like he's about to argue for successive interest rate cuts. And if we look at what the rest of the committee is saying, they clearly feel that the risk to interest rates are to the upside. So there is room for disappointment from the Trump administration, and who knows, at some point they may start to criticize Kevin Warsh as well. So I think the implications for interest rates are quite important, and I think it means that there's more risk to the upside that has emerged as a consequence of what Kevin Warsh announced. In terms of changing the communication style, there is some concern around that, because obviously if you're not communicating, then you have the risk of increased volatility, because people could get shocked by decisions that the Fed makes that you weren't anticipating. And I think people would have to get used to that again, where you're not entirely sure what the Fed is going to decide. They may well decide something that is completely different to what you were anticipating, and then markets would have to correct on the basis of that announcement. But I think from Kevin Warsh's perspective, he would rather have that than everybody simply wait for forward guidance and then react to that forward guidance and not react to the incoming economic data. So substantial changes ahead. In the short term, interest rates on hold. Inflation remains elevated in the US, with some risk to the upside if the Strait of Hormuz is not opened fairly soon. If the strait is open, then I think we'll see the peak in US inflation very, very quickly, and you'll start to see inflation subside, and that would obviously be beneficial. But I guess we keep trying to interpret the various statements from Iran and the US. I think progress has been made, so hopefully it results in an actual opening of the strait and therefore an improvement in the flow of shipping and a reduction in the oil price. Outside of that, the US economy appears to be doing reasonably well in terms of growth. The expectation is for growth just above 2%. The labor market seems reasonably intact. So the focus undoubtedly is going to be how do we get inflation down and how do we get it down to the 2% level. And I think Kevin Warsh is willing to take that on and obviously feels confident that he can make progress that is different from what has materialized over the last 5 years. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorised financial services provider in terms of the FAIS Act. Also, this podcast should not be construed as advice.